Hello there, Tom Jeffries in Howe Street Media here in Vancouver, British Columbia, at the beautiful Sutton Place Hotel. Joining us now, the editor and publisher of Emerging Growth Stocks from here in Vancouver, Mr. Lou Paquette. Lou is the star of The Week in Review with Lou every week on HoweStreet.com. Lou, it's good to have you with us today.
Great to be with you in person.
Let's get to a couple of the basics. First of all, the strategy you imply at EGS. What do you do?
Yeah, what we like to do. I use a multidisciplined approach. Okay, I know there's some letters out there that that focus on, say, the Elliott wave theory or the silver investor, that kind of thing. So those things are good tools now and again, but I wouldn't want to be pigeonholed into one sort of philosophy. So we use a combination, a blend of fundamental and technical analysis. The fundamentals tell us what is cheap, and the charts tell us maybe the good timing, when to buy, when to sell. I like to be a contrarian. I'm not a short-term trader. I like to buy things when nobody likes them, when they're very cheap. I'm a cheap person, okay? I like value. So I like the idea of buying something and holding it for a few years and seeing it go up, numerous times in value if possible. So not a trader at all. And I have a big focus on the people that run the company. In my previous life, I was in the HR business.
So you know people.
I did a lot of hiring and a lot of management training and that kind of thing. And people make a company successful. So I live here in Vancouver, and many of the small cap companies we feature, have their head offices here. So it's very convenient. I can interview these CEOs in person, and track record makes a big difference. If somebody's had a great success, they're bound to repeat it again. So I look for who's running the show.
That makes sense. So I guess everybody wants to know what looks good right now as we sit here towards the end of March.
Yes, for the year, for this year, there's a couple of themes I would carry on from last year, okay, and there's a couple of new themes that I'm looking at right now. Gold, okay, looks good. Okay, in the near term, it might be weak. There might be some seasonal weakness taking place, but we're all hearing about the debasement of the U.S. dollar. And inflation's going to be coming, and interest rates are going to go up, and that sort of thing. Gold, looks very positive as it has been in the last few years. So that's one theme we're carrying forward. Another theme might be some very selected ETFs.
What is an ETF for people who don't know?
Exchange traded funds. Okay, a couple of the inverse ETFs. Now that would be a bearish ETF. If the item that you're talking about goes down, it goes up. Okay, a couple of those worked really well for us last year. For instance, when oil was around $120 to $140, and some analysts were calling for it to go to $200, we were talking about an ETF, an inverse oil ETF, a double ETF. It was trading about $9 at the time, and it went to 45. So there was an opportunity to make a five-banger when the market was basically everything was going down. Mm-hmm. So also looking at a couple of inverse ETFs. A couple of new themes that I'm sort of focusing on this year is one is a straddle. One is a bond straddle.
Better explain what a bond straddle is.
Okay, and I don't even know if that's the exact right terminology, but it's basically shorting long-term government treasuries.
Okay.
Selling them. There's a lot of people that are talking about the treasuries are a bubble because a lot of money has rushed into the treasuries in the last little while. They're paying very low rates and the prices are very high. And there's an inverse ETF you can purchase that will play that on the short side. On the other hand, the corporate bonds are very good value right now. Mm-hmm. Okay, because of the adversity to risk in the last 6 months or so. Companies are having to pay the biggest spreads in interest rates on their bonds in years and years, like 4% or higher, okay, over what you can get in a T-bill. And the thing is, they're safer than equity. The companies won't hesitate to cut their dividends or cut their staff or do whatever they have to do to keep in business. And that, we've seen a lot of stocks go down, but they will not foreclose on their bonds because then they're out of business, basically. So there's a fair amount of risk aversion, mm-hmm. and you get really good premium rates. So going along with the bonds.
Were you surprised when you heard the Americans actually come out and admit they're going to put $300 billion into buying their own treasuries right up front?
It caught me off guard, like everybody, everyone else. It was a surprise announcement. As a matter of fact, on that day, on March 18th, gold was in the process of breaking down. It was doing a serious breakdown below a channel line and below the 50-day moving average. And that minutes after that announcement came out, it reversed and it made a huge gain, on the spot market that day and the next day in the futures. But overall, am I surprised? No, and we're going to see more of that. And the treasuries and the U.S. dollar are in bad shape in the long term. And that's why gold is so good to have right now.
You notice the Chinese are playing footsie too. The Chinese are very circumspect people, yet the premier came out and said he's very worried about the American dollar and American paper, yet they said they're going to still stay in the game. So it sounds like it's risk aversion again too.
And they've gone further than that. They're actually outwardly talking about maybe we need to find a substitute for the U.S. dollar as the world reserve currency. And Timothy Geithner responded to that in a somewhat positive manner just today actually, before I came for this interview, and the dollar took a dump.
Yeah,
So yeah, there's the dollar's in serious trouble. The United States is looking at trillion-dollar deficits for the foreseeable future. That currency is going to be debased. It's a no-brainer. Gold will go up.
How about the overall stock market and the macro economy? What's happening besides gold?
Yeah. Got to give you a kind of a backhanded answer for this one. On the one hand, good. On the other hand, not so good. On the one hand, Tom, I look at the typical chart for whether it be a blue chip company, an industrial, or a semiconductor company, or the price of oil or copper. They look wonderful to me right now. It looks like 1987. And what
Really?
I mean is, after creeping up for years and years, many of them have dropped in half. Okay, so from a value standpoint, I like a discount. When I go in the store, I like to see 50% off. I like to buy things for less than what I did, a month ago. So we've had this great big drop. A bottom was made in November. Then everything's kind of bounced. We've made another bottom recently that was higher, and it seems to have stabilized. Okay, now if anyone has followed Weinstein, he talks about a 4-stage bull and bear market, and all these charts look like they're at the early stages of a bull market. Okay, so from a purely chartist standpoint, I like the market. However, this is not like 1987. The economy, that is. We've just bursted the largest debt bubble in the history of mankind, of which repercussions are going to carry on not for months, but for years. And you and I have talked a lot about this, and when home prices go down and large assets lose value, people are not going to spend for a long time. So, on the other hand, it looks like the end of an empire. It looks like the dark ages are coming, kind of thing. It looks very, very nasty. So I'm kind of torn. And on the one hand, I want to go in there and buy things. On the other hand, I'm very concerned about the future. I think to sum it up, I would say, if you look at the history of the Dow, of stocks for the last 100 years, that we go through 40-year cycles actually, 20-year bull markets and 20-year bear markets. I believe we're in a 20-year bear market. We're actually halfway through it. If you use the year 2000 as the peak, and that should continue. And that doesn't mean it's the end of the world, but there'll be swing trading opportunities. But the good times that we've gotten used to are gone away. It's going to be you have to be a lot more selective and careful.
To be nimble, by the way, these days, may I make a suggestion? Drop in on the HowStreet.com Money Expo. We've got them coming up very shortly, 2 of them. One, April 19th in Langley, British Columbia. May 2nd in beautiful Kelowna in the sunny Okanagan. Lou, it's been just terrific having you here to sit down and talk about many, many issues. I know it changes by the hour. And emerginggrowthstocks.ca is your home, and we look forward to seeing you again here on the HowStreet.com video channel.
Thank you very much, Tom. Nice being with you.
Comments made on Howe Street Video and HoweStreet.com are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at HoweStreet.com. Howe Street Video is a production of Howe Street Media Incorporated.